like being like this. YouTube, straight.
Oh.
I just have to do it like this. Change it when they're talking.
All right, 1 minute and we'll get started.
The one that gave me the beer ticket is supposed to give me a foot rub too, I think she said. Might not want to leave, eh?
Perfect.
I just have to change to the monitor when I need to.
All right. Thank you very much for attending this one-year markets update brought to you by the Western Producer Markets Desk. My name is Randolph Glanville. I'm the Director of Business Insights and Information with Glacier Farm Media. I'll be hosting today's event, and it's my honor to be joined on stage by Jerry Clausen and Bruce Burnett. So, Jerry, if you wouldn't mind introducing yourself, and we will dive into the livestock. Just one thing before we do that, I will mention when the show is over, please leave out the side of the tent with the red cordon and deposit any alcoholic cans in the container, please. And thank you. So with that, over to you, Jerry.
Okay, thanks, Randolph. And how many cattle producers do we have here? Okay, a couple. So I'll make. I'm the shorter portion of the presentation, just for that reason. But I grew up in southern Alberta on a small feedlot, so my career has always been in the grain trade, actually. But the cattle market was always a passion of mine. So right from a young age, when I was growing up, you know, as a young guy on the farm, you know, doing field work, I'd be listening to these market reports.
12 people
always
watching,
be asking,
geez.
like, how do they come up with these prices? Like, when I would go to the auction mart with my dad, I'd say, how do these feedlot operators know how much to pay for these feeder cattle? So that was always a burning question in my mind, and that's how I developed a passion for markets. And then I graduated from University of Alberta with an ag business degree, and then I actually started in the grain trade with Cargill. So at that time I was, you know, essentially working beside the NHL of commodity traders at the time. I was in my glory at the time, okay? So, but the cattle market has always been a passion of mine because I grew up in southern Alberta. And the cattle market was unique. The first thing I realized that this cattle market's pretty sensitive, right? We have one celebrity make a comment and the price falls, or, you know, sometimes government policy isn't favorable for beef, should we say. So there's all these non-price factors that are influential to the beef market. And I start off the presentation just making people aware of that, as we have now this New World screwworm coming up from Mexico. It's only one state away from Texas, and at first the USDA, they were even reluctant to should I say, be pretty aggressive on the issue because it was so far south when it started in Panama, and we see over since 2023 it's been slowly moving north. So this factor probably is not over, okay? So the beef market is very unique. There are two factors that you have to seriously consider when looking at analyzing the beef market. An old-time cattle feeder once told me, he said, if you want to be a successful analyst, you have to look at the average income or disposable income for the average American consumer. Okay, because beef demand is inelastic. That demand curve is like straight. People eat the same amount of beef every week. pretty much, okay? And another characteristic is that a small change in supply has a large influence on the price. Okay, so we've learned that, right? We know how serious the market can be extremely volatile, you know, from one month to the next, right? So I'm going to briefly then talk about the feed grains, because that's another factor, the cost per pound grain gain, and also then sum it up with a bit of a price projection at the end. So on this chart here, I have the CME live cattle futures from 1969 through to 1983. And you can see on this chart that I pointed out the periods where the US economy moves through a major expansion phase, okay? Prior to a recession, we have higher interest rates, and then when we have a recession in the US, then the Federal Reserve lowers the interest rate, and then as the economy starts to expand, they increase interest rates again. And they do this to stimulate consumer spending, okay? And 1% increase in beef, or 1% increase in consumer spending results in a 1% increase in beef demand, because the consumer has more money. Okay, so when we have this recession, people stop spending, right? And then as the economy expands, then people start to spend more money. And as you can see, then the beef market would start to trend higher. And I've pointed out the exact peak where that expansion basically is, you know, is at its highest point. And you can see that the beef market basically doubles in that period, right? The next example is 1975 to 1980. Prior to 1975, interest rates were about 12-13%. During the recession, the Federal Reserve dropped interest rates down to 5%. And then as the economy started to expand, you can see the beef market started to, you know, increase in 1977. And then we all remember in 1980 how interest rates were at 20%, and it basically stalled out the economy, right? Interest rates were so high, people just didn't spend any money, right? And that's and then after that, you can see the beef market basically went sideways to lower, okay? So on to our next slide here. The last two recessions, we had the Great Recession of 2009, and then the economy started to expand, so did beef prices, and it peaked in October 2007, or 2014, and the cash market actually peaked in the following spring, about May and June of 2015. But that was the high. That was when the economy peaked. And after that, you can see the market started to come off. As soon as that consumer pulls in the reins, then beef demand starts to decline and the market starts to fall. Our last recession here was in April of 2020. And then again, the interest rates, they put interest rates right down to zero, remember? And so cash was readily available, disposable income starts to increase, and we're still in that phase. They started to increase interest rates in 2022. In halfway through 2023, they were at 5.5%. And now last year, they started to decrease rates, but we're still at the higher levels, right? So you can see that in these two examples, they last about in the 2009 to 14 and the previous one, and I can show you examples in the 80s as well, it basically lasts about 5 years. So you can see we had the recession in 2020. You can kind of project like in 5 years we're going to be at the highs, right? That's kind of a past precedent. And so, next slide here. The next slide I show is the U.S. calf crop, and you can see in 2014 the calf crop was at its lowest level. And we're at that level now again. We're basically at the 2014 lows. And so we're seeing a serious decline in the cow slaughter, and that by itself is enough to increase the calf crop. But we'll likely see some heifer retention this fall, and then we'll see those calves come on the market next year, and then we'll see that increase in supply. So 2025 will be the first year-over-year increase in the calf crop, and those calves will come on in 26, and that will be the end of the route. this slide here shows, okay, we have the lower calf crop, lower feedlot placements, lower beef production, right? And next year, the first quarter of 2026, that's when we're expecting beef production to be at its lowest level. And then after that, we start to see beef production increase. So we're probably about 8 months from being at the high or the high to be in place. Okay, so the next slide, the cost per pound gain, and Bruce will touch on this too. We have a very large corn crop in the US. There's so much corn there, they're going to be pushing it into southern Alberta. There's corn trading into southern Alberta now already. And so that corn crop harvest comes on in October, and so we'll probably start to see a huge, should I say, imports of US corn, following November, through the first half of next year. So this record corn crop comes on the heel of a Brazilian record corn crop.
Is that corn tariffed?
No, there's no tariffs on corn. And there was no tariffs on the list when they were going to put their retaliatory tariffs on. There was no tariff. Corn was not on the tariff list. Ethanol was though. And so my final projection here, like I say here, we're probably nearing the highs on the CME futures around 340. We're probably near or at the highs now. When the market moves into that expansion phase, the feeder market usually overextends to the upside because of the heifers are held back. So there's lower supplies actually, and the market moves high enough so that, should I say, the market rations demand. Feedlot margins have to move into negative territory so that they back away from the feeder market.
Excellent. Well, thank you very much, Jerry. It's an excellent insight there. Jerry will be taking more questions at the end. And now I'd like to bring in Bruce Burnett. He'll be talking about crops.
I'm Bruce Burnett. I've been looking at weather, crops, and markets for 30 plus years. So this year I did a little tour of Western Canada, getting to Saskatoon here. Sort of the roundabout way of getting out here. But anyway, I got to see the crops. You see the map on the screen. Basically, that shows us the moisture that we've received as a percent of what we normally get over the last 30 days. That's getting a little old because it was made before I drove out to Saskatoon here, but that map doesn't change too terribly much, even with some of the rains that we've just had. The takeaway is that the southern prairies and Manitoba have received the least amount of precipitation compared with normal over the past 30 days, which is, the last 30 days and the next 30 days are the most critical for our crop growth cycle. And on the tour, I drove across the southern prairies, and it shows up pretty quickly. Manitoba crops look good. Southeastern Saskatchewan crops look okay as well. You get into, let's say, the Assiniboia area, South Central Saskatchewan, all the way out west to southern Alberta, it looks really rough. And a lot of very poor crops. The crop most impacted by this in terms of Western Canadian production is durum. So our durum crop is going to be smaller than we thought this year. We planted more durum because we wanted to produce more durum, and we're going to produce less durum. My call on the yield right now is it's probably about 2.4, 2.5 bushels an acre less than last year. And that gives us production less than 5.5 million tons. We had a good durum export program this year, and there's no reason why we can't have a good durum export program next year, which is going to make the durum situation a little tighter than you would have for comfort. So I think, again, in terms of markets, in terms of durum evolution, it's going to be a little bit different than the other grains, which I'm going to talk about because the other grains are going to be influenced a lot by corn. The other crops grown in the south, lentils look okay. Really need a drink. Every area of the prairies probably needs rain, but I don't think I met anyone at the show when I was driving around that said, "Oh, we don't want any more rain." It's just not a thing in Western Canada. But anyway, The good news is that it looks like our forecast is going to be a lot more positive than it was last year. Last year, the crops looked excellent around this time. And then we had essentially 6-8 weeks of hot, dry weather, and it just dropped the yields dramatically in virtually every crop. Well, this forecast here, in terms of the weather over the next 2 weeks, actually even into early August, really looks to be a far more positive. Temperatures are going to be closer to normal, so closer to average, so none of this blast furnace type conditions, and a little bit more rain. So that's going to help our crops finish off a little bit better. The bad news is they're not in as good a shape as they were last year at this time. So I think the two sort of even out, and we're looking at fairly normal yields for the crops that aren't growing in the south. So in the central and northern areas, crops look good. There are some variability in certain crops, especially canola, and that was probably caused mostly by the dryness in the spring, uneven emergence, etc. But if we get this weather forecast, the canola is going to have far superior filling conditions. We won't see the heat blasting on the blooms, so I think our yields are going to be okay. So for spring wheat, we're looking at yields that are similar to last year, just slightly higher. We planted less acreage, so we're going to see a drop in spring wheat production a little bit. For barley, a little bit more acreage, pretty good yields. In fact, yields probably about a bushel an acre higher than last year. We're going to look at reasonable supplies for barley. But again, we'll talk about how corn's going to impact that a little later. In terms of the canola itself, we're looking at yields pretty similar to last year. If we get those excellent growing conditions, we could see it bump up a little bit. But we reduced canola area this year, so the production is going to be low in canola as well. And unless we see a dramatic improvement in the crop, we're probably going to come in less than last year as well. So in terms of the corn situation, U.S. corn crop, Jerry says it's going to be massive. I estimate that the yields are probably going to be up around the 189 bushel an acre area. Just to give you an idea, USDA is currently using 181. So almost 190 bushels an acre. That's going to lead to huge supplies of corn. And unfortunately for the U.S., their export markets are going to be somewhat limited. Some of this is due to the tariff activities. So we're going to see a lot of corn move northward just because it's going to be fairly cheap. I'm looking at December contract lows in Chicago corn around $3 a bushel. So we got to lose about $1 a bushel probably from where we're at now in terms of corn. That unfortunately going to impact some of the other grains. Barley obviously, because we're going to displace some of the feed demand for barley. So that's going to keep a lid on prices. Not necessarily for malt's a different animal. It all depends on what kind of harvest weather we have, etc., etc. But in terms of the feed component of barley, it's certainly going to be under pressure. Wheat's also going to be under pressure to corn. We have very wide spreads between corn and wheat. The Chicago contract, that spread is over $1. In some years, those two are pretty close to even. So it's a historically wide spread. Plus, on top of that, we have a spring wheat spread of about 70 cents to Kansas City. So spring wheat's doing okay in terms of the markets, but it's going to have to lose some of that premium that it has to the other wheats and to corn. So I see pressure on the wheat market, probably a flat to lower market here until we get through the U.S. corn harvest, get through the North American harvest. On the wheat side, the only hope is the Southern Hemisphere crops. Australia's in trouble right now. Western Australia is very dry as they're planning their this upcoming crop. Essentially plant during our summer which is their winter, and then harvested in our winter, which is our winter, which is their summer. So basically, you're looking at probably a drop of 5 to 7 million tons of production. That would be significant in the market. But for here for now, harvest is coming off right at the same time as the U.S. harvest is coming off. So we're seeing a lot of pressure in the world markets right now. So not a great scenario for prices. The last thing I just want to talk briefly about is canola. And canola is very interesting this year. Probably has the most upside, and it almost has the most downside. So just one of those things, it's highly dependent on tariffs and how the tariff situation evolves. Now, I don't think the tariff scenarios will play out. I think we'll come to an agreement with the U.S. I think China will not put on a tariff on our seed. If that happens, then canola prices are going to be fairly strong. I expect canola to trade between 700 and 750 bucks a ton with our current estimates, and possibly hit above the 750 bucks a ton on the future side. But it's going to be a yo-yo market. Any tweet, any indication that we're going to change the tariff structure, then the market's going to drop and then back up. So, like, we lost 100 bucks a ton in February just on some tariff rumors. They did happen, but it was only to the products, it wasn't to the seed. And then suddenly everybody realized this, and China's still our major import market for canola. So, or export market for canola, sorry. So basically what I'm saying is it depends on the tariff structure and how that evolves. That's a lot of risk for you guys who are farming. So what I would say is, if we get some rallies here, concerns about supply, whatever, get the prices up, then I take advantage of it and sell some, especially if crops are looking good, because you can't afford to take the risk of this thing dropping by 50, 100 bucks a ton just on a rumor. So something to keep in mind as you go through your marketing year. An additional word on pulses. We've got a lot of questions on peas today. One thing to remember is the Chinese tariff that is biting the most is probably in the pea market. Our largest customer for peas, and it's still got a tariff on peas going into China. So that's something to keep very mindful of. The entire protein market, plant protein market, is under pressure because we're crushing a lot of the oil seeds for oil, and that means there's an excess meal out there. So we're seeing low soybean meal prices, low canola meal prices, a lot of pressure there, and it impacts the pea market as well on the feed pea side especially. So with that, I'll leave it up and turn it over to Ranulph again.
Yeah, thank you, Bruce. So we will take some questions from the floor. If you are leaving after the event, please do leave out the side of the tent. And are there any questions at all?
So a big drop of canola today. Oil, soybeans up. Yep. Dollar fairly stable.
Okay, the question is, canola's down today, and all of the other counter markets, soybean oil, going up. My answer is welcome to the canola market in 2025, because this is the way it's been traded. There's no real reason why it dropped today. It dropped, I would say, more probably because of some fund selling. The one thing in the canola market to remember is that funds set a record long about a month ago. They've been easing off of it, but certainly there's no reason for it to drop that much fundamentally. It's just a market noise day-to-day thing. And you'll note yesterday, beans were down, oil was up a little bit, but canola rallied yesterday. So those are the unexplainables. It's one of the reasons why I look at weekly charts more than daily charts almost, because it at least gets rid of some of that noise that you see. So Any other questions?
What about the lentil market in India?
The lentil market in India. Okay. The lentil market in India, again, is generally governed by their policy and how they set the tariff or import restrictions on lentils. It has been quite strong, but they've just harvested their rabi crop a couple months ago. It looks to be fairly strong on the pulse side, so I would anticipate that demand's going to be down in India for lentils. So that's a concern for the lentil market. It's just one of those things. I think in the previous session I said India does have a tariff situation where they will protect their farmers, and that's their sort of number one priority. So in years when they have a good crop, guess what happens? Import restrictions and tariffs. And I would anticipate we're probably going to see that this year in both the PM and local market eventually.
Is Australia okay with their crop?
Okay, question was, is Australia okay with their lentil and pea crop and whatever? The drought I talked about is Western Australia. Western Australia doesn't produce a lot of the pulse crops. There's mostly wheat and barley growing in Western Australia. Most of the pea and pulse production essentially is in South Australia, Western Victoria, and southwestern part of New South Wales. That area is still fine in terms of the production or the moisture that they've had so far. And again, it's early in the growing season, so we'll have to continue to monitor it. But it's looking, I would say, comparatively better for their pulse crops than it is for their wheat crop production.
So you expect lentil, red lentil to be lower than 29 cents?
I think there'll be a floor here somewhere. I don't think it's going to be. Again, I don't think we're going to get into the low 20s. We do have a good lentil crop probably coming if we get some rains and good finishing conditions. The other thing about reds is that we planted less of them this year. So that's the other consideration. It might be a little bit tighter. So I think, again, probably upper 20s is more where we likely want to trade here in the next, through the harvest period, at least.
How are we looking on Durham?
How are we looking on Durham? Well, again, I think the yields are down. Production's going to be down about 400,000 tons. We had a really good export year. We tightened the stocks up. I think there's positive news that can happen for Durham in terms of if we see good demand continue, Durham prices should probably appreciate through the growing season. Having said that, remember that wheat's probably going to be headed in the other direction through these other market season. So there's some limit where you can't get the Durham prices to be that far away from the wheat prices, or else customers in North Africa and the Mediterranean basin start to substitute a little bit, using some more spring wheat or whatever into their blends to make their crops or make their products.
Do you think the Port of Churchill will have a big impact on farming in the next 10 years?
Port of Churchill,
because they're wanting to develop it up.
yeah, there's a lot of talk about developing up. I think, again, a lot of that depends on how much we invest in icebreakers, because you're going to need that. I think it probably has impacts in other areas other than export markets for grain, but it will be, I think, with an investment, a significant player. I'm probably more interested in some of the other commodities that can be moved offshore other than grain, just basically because most of our trade right now is off the West Coast, and I don't see that changing that much. And so that's driving the economics of using the Port of Churchill or even the St. Lawrence system. Okay? Any other questions?
We have $3 corn coming.
Yep.
How is that going to affect the market next year? They're not making money at $3.
Yeah. But the question is about next year. What does that impact? Well, low prices always clear low prices. The combination of that plus the higher nitrogen prices that we're going to see this upcoming year, that's going to pull the corn area down, and we'll see a flood back into soybeans, and so the pressure will be in a different area and make things tighter. The only thing I'm concerned about from the corn side is that there'll be a lot of hangover from this crop because they're not going to be able to export it all, and that's going to have maybe a tail of a year. So even if they've dropped their production.
Yeah, but don't you think the Chinese are just waiting for the market to come down? Record lows and then they're in.
No, because they don't need the U.S. soybeans. They don't import a lot of corn to begin with. So it's like they don't need the U.S. to supply them soybeans. Brazil has a record crop, and next year, guess what? It's going to be another record because they just plant more and more urea. So they're displacing it. The Chinese will be more willing to buy it, store it, ship it late, whatever, in order to push the U.S. out, as long as this dispute continues. If you see a resolution to that dispute, then that's a bit different. But we're here for now. The Chinese are, it's a lot different situation than the last war that they had, trade war that they had. They don't need to buy a lot of U.S. products, and they're going to use that as a hammer, you know, in negotiations. What?
No, they're stronger than us.
Hmm?
China's stronger than us for in situation. He said they're in the same situation as us, but they're
At least
stronger.
they can eat their way out of it.
Yeah.
Yeah. Well, you know, again, they've on pork, on other commodities, they've come closer to being self-sufficient, or they develop relationships with other suppliers, because guess what? It's a bad thing to rely on just one supplier, or one supplier for a commodity. Okay?
All right.
What about the pork market?
What about the what?
Pork market.
The pork market? Again, it's got a little afterglow from the beef market, because again, that's helping push prices higher. Corn, the problem with hogs is it's going to be fairly profitable with the lower corn prices, so we're going to see probably again pressure on the market from supply. So that's the thing. Again, I don't know that much about the hog market, but that's sort of where I put it at. On the retail side, we are seeing improved demand for chicken and pork because of the high meat prices.
Excellent. Well, great questions. Thank you very much for attending today. If you enjoyed Jerry and Bruce's insights, you can continue to receive them through the Western Producer and our other publications. But do enjoy the show, and please exit out at the red stanchion. Thank you.
Thanks for watching. Have a good time.
Yeah, thanks guys. Thanks for coming.